amazing policy coming out of America. $100 billion is being committed by the Import-Export Bank to fund nuclear expansion in America. $80 billion going to Westinghouse. They're going to build 10 new reactors by 2030. It's hard not to see the uranium investments go completely nuts at some point over the 2 years.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
All right, so this is the Finances Podcast, and this is our quarterly market update with Sam Crompton, Senior Investment Advisor at Shaw & Partners. Sam, thanks for jumping on this morning, mate.
Well, it's nice to be here, Joe.
Now, mate, I thought it'd be a good opportunity. We're nearing the end of the year. We're nearly at the Christmas period. Even though this is our quarterly update, thought it might be an opportunity to actually reflect back on the last 12 months of the full year, and then maybe narrow it down to how you've seen the last quarter and then the last month. So maybe just give us your thoughts, mate, on the year that's been, and then where we've ended up in the last month from a market point of view.
Yeah, great. Jay, so it's probably, the biggest thing, I suppose, is getting used to the new US administration. That's probably provided the most volatility in markets, and it started early on in the year, or mid-April-ish maybe, around tariffs. And obviously, a lot of haters out there on the tariff front. Stock market got absolutely collapsed. But if you kind of listen to what the administration was talking about, it was a bit like a call to arms to get countries to come to the table and start chatting about reciprocal tariffs, etc. So the market got used to it. We're getting, deals here and there. Essentially, though, the underlying focus here is that America is focused on America now, and businesses that are tapped into America could potentially certainly do very well, certainly on the defense side, technology side. It's about reshoring. It's about maybe pulling back from this global focus and focusing a little bit on America. And our focus certainly is on global funds or global investments that benefit from this in the US. Obviously, so we're broadly bullish on what America's doing. Obviously, they want lower interest rates, which we got last night, 25 basis points. We want to see some more. That's kind of played into a little bit of the stocks falls. We got a massive rotation out of high growth stocks into just the opposite, really, into sort of quality to low growth names, I suppose. And that rotation was pretty brutal. And I'll come to talk about how we're taking advantage of that sort of a little bit later on. But I think America, there's a couple of people that I listen to out there, and a couple of funds are sort of highlighting that Americans can enjoy potentially a boost to their back pockets through a once-off check and maybe some tax credits. And you're going to see a lot of sensible policy where they're encouraging investment in small businesses, and that's going to be like getting a deduction for investing in CapEx. And so midterms is important. I'm hearing from, listening to individuals talk about how that's going, and it seems like America's moving a 4-point swing towards the Republicans, which maybe that's a good thing depending on how you feel, but it's probably good for stock markets, I would say. And also, they're really just coming out and doing deals to suit America. They did one with Australia, which is a rare earth deal, and our government sort of claimed that as a bit of a win, but that's just America being sensible and saying, hey, we need this stuff, and who are our allies and where can we get it from? And so that was good to see. One of my sort of favourite sectors, just because it makes so much sense, is the nuclear space. America's gone big. They're $80 billion into nuclear reactors. That is coming. Chairman of NVIDIA, Jensen, forgotten his surname, he essentially is saying none of this AI happens without nuclear, which is music to my ears. And that's some reward for giving myself a few more grey hairs this year, because it's been a volatile sector. And back to an Australian focus, right? I don't see the same vigor when it comes to promoting growth. We were, pretty much everyone I speak to doesn't go, yep, we're on track. We like what this government's doing. It makes us feel warm and fuzzy how much they've got the back of small businesses. There's none of that. And for that particular reason, the benefit of equities is I like Aussie listed stocks that have a global focus, right? Obviously, housing's strong in Australia. I get that. Interest rates like they're going to go higher. Some say we're going to get a good old commodity boom, but I just see tired old rhetoric from Australian politicians. There's not, they're just, even the Liberals, even if they're bumping into each other and trying to figure out which side of the fence they're on, the rest of the world has moved on. The world's biggest economy has got a clear picture. And I just wonder, I hope we get some sensible leadership, a few more sensible policies coming through. I just want Australians to be taken care of and to maximise this wonderful country we have, right? Like we've got so many things going for us. But I just hear the policies, they're just nonsense and they're not about pro-growth. They're just farting around the edges and just generally annoying everybody, right? Most savvy businesses people I speak to are not happy. They're upset. They want to see change. And so I don't know who voted for the government, but maybe we need to see a bit of pain to realise there needs to be another solution. Because I honestly, I haven't really seen it yet. I see the changes with Barnaby Joyce and One Nation, and that's getting a little bit more following, I suppose, because Aussies maybe we're finding that things are bursting at the seams, and we're happy to embrace everyone, but like the fundamental issue I see with this Australian government at the moment is they don't seem to understand how economic policy works. So if you've got an inflation problem, don't have the highest ever government spending we've had on record. Like, back that off and let the economy cool down, let the private sector come in. Don't have your immigration gates open flat out. Like, bring in the people we need to build houses and help the mining sector and what have you, but be selective and leave the immigration when we really need it, which is when we're in a deep recession, whenever that may be, right? So just be sensible around that. And then obviously the first home buyers front is just putting fuel on the fire. That obviously is a dumb, like it's 5%. It's just making property more expensive. Good if you own property, I get that. But it just makes it harder for the young'uns to buy property overall. And I just think you've got all these policies which are against letting inflation cool down in Australia. So I just that's probably going to have to change. But anyway, that's kind of my broad view. Australian market, in terms of value, there are things that we like. Some things are expensive. Obviously, the banks had a really good run, and that's more, as we find out, more about index inclusion than value. And so, we are picking the ones that have been hammered in the recent fall. So your clients will start to see us adding things that, like, for example, WiseTech is a very topical stock at the moment. Now that's come down from 100 odd down to sub 100. We speak to a lot of fund managers. We love speaking to fund managers because they are hyper focused. They'll generally have teams of 5 or 10 on specific areas, and so we get a lot out of it. Plus, we get everyone else's research. But WiseTech essentially is priced now as if the founder never works in the business ever again, right? So there's obviously some controversy around him. I understand that their core product, CargoWise, is the best in the world, and I love those businesses on the Australian market that are the best and unique, and they're listed on the ASX, and they essentially have a global focus, which is great. So it's been painful because it's had such a big pullback, but we are nibbling, we're buying, we're adding, we think it's good. And we're actually having a sit down. Richard White's coming to our offices in Sydney. And so I have more to discuss on that one. I'll put it in the note, summarize it to you guys so you can share that with your clients. So that's going to be pretty interesting. We're buying Xero. Xero is an accounting package. They are just blending AI into their offering. Stock made an acquisition. Market didn't like it. We think it's long-term. It's fine. So that's another one we're buying. A new one we're starting to add, not nearly there, is a family tracking app called 360.
Yep, got that myself.
Right, I've just got it, and you got to remember to turn it off when you're Christmas shopping for the kids, because they know exactly where you are. It's a bit creepy. So I've got to perfect that, but I've sent it to mum and dad. They're in their 80s in Perth, and I'm in Adelaide, so nice to see. I can track them and see what's going on. 88 million Americans use it. They're going to add it to the pets, which makes a hell of a lot of sense. So you'll never lose your dog ever again, or cat, or budgie, or whatever you want to, put a tag on. So it's, and they've really offered good value, right? And or better value, I should say. So that's interesting. In the income funds, we're adding a sort of a new infrastructure fund, if we haven't started adding it already, which is primarily focused on they own a bunch of energy generation assets around the world.
Which one's that, Sam? Did we say who that was?
It's the Resolution Capital Global Listed Infrastructure Fund. It's a bit of a mouthful. The code's RIIF, and the dividend's up there. 45% of what they own is in utilities, 7% toll roads, rail, towers. So it's a real infrastructure fund, but it's global, and it sort of complements our exposure. Most of your clients will have Origin Energy. Origin, we really started buying after that takeover offer didn't happen, and it's just all about energy, right? Like, nothing we use on a daily basis matters, but without electricity, and it's just getting, certainly in Australia, like, we're hard to see energy prices going down from here. I love to see it if they did, but we're just not buying enough generation to keep up. We just don't get it, and so it's going to be interesting. So we still like Origin, but we're adding this one into the yield focused clients. Did 11% last year, so we like that. Just switching to some of the global funds, one we've been adding, and we're preferring this. We're adding this now instead of Qual. Not to say Qual's not great, but it's a similar version to Qual. It's called the Plato Global Alpha Fund, and 35% per annum each year for the last 3. These guys essentially have like a model basically that screens a zillion stocks, and they pick them on all sorts of different filters, and they're doing a great job. In the last month, they've done 9%. Last year, they did 41%. And they go short and long, which means they can buy stocks and hope they go up, and they can short sell stocks and hope they go down. So you'll find these guys will outperform in a volatile market a little bit more. Just touch on uranium. Amazing policy coming out of America. $80 billion. $100 billion is being committed by the Import-Export Bank to fund nuclear expansion in America. $80 billion is going to Westinghouse. They're going to build 10 new reactors by 2030. It's hard not to see the uranium investments go completely nuts at some point over the 2 years. It has definitely given me grey hairs because it just goes up and down all by itself. It gets wrapped up in the AI trade, which artificial intelligence, if someone says, oh, there's a new model coming out of Japan or what have you, it comes down on the back of that, which kind of makes no sense, right? Like, it doesn't matter which AI model someone chooses and whether it's free or it replaces 20 people or 10 people, you still need to power it. And essentially you're seeing technology companies invest directly into nuclear. So it's coming.
So what are those, just for, so we can put some qualifiers on this for the uranium plays? What are you seeing? What are we seeing? What have we got in client portfolios that they've got that exposure at the moment? Or what are you liking or potentially adding in?
There's 3 exposures we have. One of them is NextGen. NextGen is the largest undeveloped uranium deposit in the world. When it's in production, it'll be a top 5 miner globally, which, if you just think about that for a second, it doesn't make any money right now because the mine isn't developed. But when it is, it'll be up there with BHP and Rio from one asset in one commodity in Canada, right? So it's mind-boggling how important this is for the whole uranium space. What's exciting is they've also they're exploring for another deposit, which looks even better than their first one, which is crazy. And because I'm obsessed with uranium, I know the company well. The CEO just happens to be in Adelaide, so I've taken him out for lunch a couple of times, and he tells me that his geologists say that they're just scratching the surface, right? So this is such an important asset globally. It might get bought out by BHP, we don't know, but it's certainly within the Americas, if that makes sense. So when America can make friends with Canada again, or their presidents and prime ministers can make friends with each other, that's going to be a really interesting part of the world. So other one is Paladin, Aussie listed, obviously. So is NextGen. Assets around the world. Just bought a big one in Canada. We like that one. And then URNM is a global exposure to uranium. So that's essentially how we're playing that. And we're the URNM captures other parts of the uranium cycle. It's not just digging it out of the ground. It's Cameco, which is an all-in-one company that digs it out of the ground and refines it and enriches it. So it's a big trend there. And it's important to note, I still get some pushback from clients who say that nuclear energy is bad and they feel that I shouldn't be investing in it because it's somehow not ethically correct. That unfortunately, that has been it. This is not about weapons. This is about net zero. So, some very informed people tell me that if you are for the environment and against nuclear energy, you've been misguided, right? Like you are. It's not. Net zero doesn't happen without nuclear energy globally. So it's about carbon-free emissions. The whole adage that it's going to be used, like having any opposition to it, is you need to do more homework, basically, because it's essential for net zero. The nuclear reactors these days are so much better than they were before. And if you look at the track record, they've been very effective, right? Certainly Germany, right? Germany turned their reactors off on an ideological basis, which was wrong. It left them open to energy being imported from Russia, which obviously, we don't need to see how that ended, right? You could eat your breakfast off a nuclear reactor in Germany, right? They have zero incidents, but they turned it all off, and now their power costs are through the roof, and they're now globally less competitive than they were before. So the world is coming back to it. The World Bank is now funding projects that hasn't happened for 50 to 60 years. So the old adage that it was somehow no good and not an ethical investment was complete hogwash, right? So it's actually kind of an amazing energy source. So we're obviously, to sort of sum up, we're finding value in certain pockets. We wouldn't say the whole market is super cheap. If we look at some like obviously we're buying, like we think. So the next thing that I'm keeping an eye on is James Hardie, which has had a tough run. That's actually the same time they made a big acquisition, the whole sector for building in the US really took a dive, and we're going to see lower interest rates hopefully stimulate that. But broadly, we think the Aussie market's kind of fully valued, and we need to see our strategists are suggesting 8,900 by 2026. That's a 6% return. That doesn't sound amazing, but we're seeing domestic economies modest upward EPS revisions. They're sort of some of the sectors that have been lagging are improving. Margin supports are there. We're still seeing like a lot of businesses that could be enhanced by AI that they sort of derated, and they're expecting to see that sort of come back into share prices. So we're looking. I think we're looking okay, but like I said, nothing. You've got to pick the eyes out, right, to get returns. Hopefully, we see some moves in commodities. Copper's doing really well in Australia. That's really good for BHP, but it's good for Rio. You probably see BHP and Rio in most portfolios, certainly in the growth portfolios. And then to America, which I think is probably going to lead the market next year. Hoping you see sort of uptick in consumer spending, some benefits from government policy around tax relief come through, lower interest rates, fingers and toes crossed on top of the last cut, and just generally a more favourable environment for small businesses over there. The new administration certainly is trying to help them, so they say. and a lot of spending, a lot of sort of benefits for companies and small companies to bring forward their capex, and so that's all good. Plus, the thing which I find strange, but it's not talked about a lot, $17 trillion of money from overseas has been earmarked to go into America, right? So it'll be interesting to see how that goes, and whether that comes through, because that's going to put some inflationary pressures in there, I would have thought. But we're the whole market isn't a buy, but we're certainly finding out pockets of interest.
Is there anything that you've been surprised with this year that maybe you've leaned away from specifically, whether it be anything sector specific or stock specific that you've maybe misread and you've decided to take a different direction on?
Well, we're running a little. We had a bit double exposure to data centers through Goodman Group and NextDC, and so we've just been taking NextDC out and adding more of a small cap fund, just because we're hearing that that always requires capital to grow that business, whereas Goodman Group seems to self-fund a lot of their acquisitions and their data centers. What else have we been doing? We've been surprised at the strength of the banks. Supermarkets have been a disappointment, specifically Woolies, but we're not abandoning that one just yet. We think that they always do this. Coles does better for a while, then Woolies does better for a while. We certainly probably would have liked a little bit more gold in portfolios. So we're probably looking for a dip on that one. And obviously, liked the uranium a lot, but it hasn't really provided lots of volatility, which is kind of hard to fathom. But yeah, I'm sure this. Oh, James Hardie, right? So that one was a train wreck, right? Like we love James Hardie. It was doing really well. We've been there for a long time, and obviously we've been buying it, so it's our fault. But we didn't know the company was going to go and do an acquisition and completely annoy all those customers, also all the shareholder base in Australia, and you had all that selling from companies that they're not on the Aussie index, so there was selling pressure. So that was a bummer, but we're sticking with it, and we're looking at nibbling at lower levels to bring the averages down. So yeah.
And mate, we won't hold you to this, but I want you to cast your eyes forward to 2026. What do you think? What's your view? What do you think is maybe going to be surprising about 2026? What do you think is going to hold? And anything we should be specifically paying attention to or looking out for?
Well, I'm hoping all these conflicts get resolved, right? I think the US administration's proposing more of a, less interventionary kind of focus. And I get all the noise around Trump and no Trump, all that sort of stuff. But it'd be nice to have a lot less conflicts in the world, right? So we can just get back to, living, I suppose. Not that it affects us much down here, but there's so much time taken. So it'd be nice to see what happens where there's a more harmonious world. Certainly the Israel thing, maybe that's sorting itself out. I think America will surprise everybody next year. I think, you're going to see that really rip. There's some getting a few things lined up. I think it's going to be kind of pivotal with the midterms. If that goes the Republicans' way, they're pro-growth. Love them or hate them, they are pro-growth. They're about making America stronger, and that'll be, one of the reasons we're focused in America. To be honest, I don't know around Australia. We are a resilient bunch, right? So interest rates look like they're heading up here, right? So that's going to be interesting to see how that plays out. And I guess I don't have any particular insights in Australia other than it'd be kind of neutral if I was to have a think about that. And I just think it'll be more of a stock pickers market going forward. But certainly looking to see strong lead from the US, not without its hiccups and its drawdowns, when Trump says something people don't like or tariffs are worse. But it sounds like the bigger powers of the world are trying to work it out. Less so much Europe, but more China, more America. And that's kind of, potentially where the growth's going to come from.
Seems like still that that idea of piggybacking off the sort of the pro-growth focus of the US remains a pretty big constant, will do for the balance of well, the foreseeable future. Again, I think that you've made that point pretty clearly, that, you know, love it or hate it, the US and the Trump administration are very pro-growth, and when we're talking about you know, client portfolios and seeking growth and seeking returns, you can get emotionally attached to what's going on politically, or you can look objectively at where the money is flowing and where the returns and the opportunities are. And I think that's one of the great benefits for our clients, I think, is having sort of that objective view held by the likes of yourself and Adam at Shaw's, to be able to sort of give us that detached perspective on what's happening in the market. Because it's very easy as individual investors and clients, I think, to really be a bit too focused on the emotional aspect of it. And we hope as advisors, our job is to kind of sit as that unemotional observer and take the data and then make decisions about what's going to be in their best interest. So I think it's awesome to hear sort of that macro perspective, but also to get a sense of you know, what we think the next year's going to actually look like. And we promise we won't hold you to it, mate. And I know we're I'm mindful of time, but I'll maybe want to give you the last closing thought on anything we perhaps have missed around the markets, the update, and where the next sort of quarter and 12 months is likely to head.
Well, so right now I'm sort of positioning for a bit of a bounce in the names that have been oversold, as the US focus on rates is lower for at least the medium term. So hoping to see a rebound from there, and hoping to see, you know, a stronger US market in the new year, and just continue to see what's working in Australia. Right, look for pockets of value, looking for oversold ideas, fingers toes crossed, looking for this sort of your energy complex to really start to move. You might see some. You're starting to see a sort of more sensible approach to miners are cutting spending on things that are not making sense, which is this push towards net zero investments, which they're pulling back from, right? And you know, we've got to recognise that where our energy comes from is traditional means, no matter how much we've been wishing that they wouldn't, or told to think that that's the better way to go. It's kind of back to basics on the energy front, and that's where the money's going to get made. We've a little hot tip that we've done, maybe not for, it's a higher risk client investment. It's not, you won't see it in any of the recommendations, but a stock called NH3, which we've got a bit of money in for our certainly our speculative money. They're building an ammonium plant in the Pilbara. It's happy to run you through it in detail, but it's the epitome of what's going to work in the world, right? So it's taking gas from the Northwest Shelf, it's converting it into hydrogen and then into ammonium, and ammonium is going to be the new shipping fuel for the next generation, right? And it's an 80% reduction in emissions. Yes, you're using gas. You do create CO2, and they've got a collaboration with Woodside to put that gas in the ground, carbon capture, right? And so like it's a bridge between the perfect, which is net zero, and the old world, which is carbon, you know, obviously creating carbon emissions, but it's somewhere sensible in between that generally works. And so, you know, you're going to find this is a $1.4 billion project, which has got the backing and the blessing of the West Australian government. They've just done 2 deals with 2 of the largest shipping companies in Japan. And my point being is that, yes, we all want a cleaner world, but we don't want to kill ourselves doing it, right? And this is a nice little project in between. I think you'll start to see more of that, a more sensible approach to the big problems we have. So...
Well, it's a nice way to close it out, mate. It's always love getting your insights, and obviously, certainly if people listen long enough to this podcast, they'll hear the disclaimer at the end that these aren't recommendations, but it is. But it's always good to actually to get some insight into what we think is is likely to sort of provide the investment opportunities in the future. So and even as of now. So, mate, thank you for your time. Thank you for yours and Adam's support over the last 12 months. I know our clients appreciate it, and we certainly do as a business. So, thank you very much. Wishing you guys a Merry Christmas, and we'll see you guys Q3 next year.
Nice one. Look forward to it. Thanks, Jay.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, YouTube, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners to check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening. Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decisions, listeners should consider the appropriateness of any information with regard to their particular objective, situation, or needs, and seek advice from a licensed professional specific to their circumstances. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of Acumen Financial Planning, ABN 89051208 327, Australian Financial Services Licence 232706.